What's up, guys? Hope you've had a great week. It's been a crazy week. Lots going on. We had GDP, we had PCE coming in. GDP slapped everything down, slapped equities down, slapped bonds down. Everything was hot. The economy's hot. Everyone was worried inflation's going to be an issue. And then PCE comes out and completely reverts that idea with bonds completely reverting what they did the previous day. Not completely, but about halfway. So bonds, essentially, they're really not signaling that inflation is going to be much of an issue. If inflation was really going to be an issue, we would be seeing bonds breaking down to new lows. At least the prior lows from a few months ago, we would be seeing that breaking down if inflation was really an issue. It doesn't seem like it is.
Yeah. At the moment, no.
At the moment, no. Obviously, anything can happen. But that GDP did scare markets a little bit, scared bonds. But PCE came in. Fed looks at PCE. And so it's really too early to tell. It honestly feels like the waters are murkier than they used to be.
Right. And we'll go over that in a little bit in terms of like why the inflation landscape is slowly shifting. We'll go over that towards the end of the podcast. But let's talk about what's going on with the Nasdaq. Right, everybody is in shambles. Everybody's so confused. The Nasdaq's up 236 points on Friday before the not Labor Day, 4th of July weekend, and everybody is wondering how can the market go higher? Right? Why is this market bidding? And will it ever stop? My answer to you is this market can, in fact, go higher. The trend is bullish. We said this last week. We say this pretty much every week. Keep it simple. Trend is bullish. Market can go higher. Now, why is the market going higher, though? The answer is real simple. It's the soft landing. The impossible soft landing that nobody can possibly wrap their head around being, happening or coming to fruition is exactly what's coming to fruition. Now, you're seeing that happen with equities slowly going higher and bonds, as we showed you just before, going nowhere. And the reason for this is because, as Artie just explained, as you just said, Artie, GDP came in hotter than expected. Everyone's thinking, oh boy, inflation is going to rebound because if you don't kill growth, inflation is going to go up. Obviously, PCE, it did come in under expectations and inflation is on the downswing. So this is building the narrative of the soft landing. And we also had jobless claims come and take a dive. So everybody is thinking, well, labor market isn't blowing up and growth isn't falling apart. Inflation is coming down.
It's expansion. This is textbook expansion.
Right.
It's what it seems.
And what it seems, right. Exactly. So long story short, for equities, they can bid. Do not listen. I understand your urge. Like, for example, take a look at NVIDIA. This is ridiculous. I mean, we're talking about 184% year to date. Ridiculous. One would think this is the easiest short. This is probably one of the hardest stocks to short. This is probably one of the stocks I would not ever short because these are the cult stocks. The Tesla, like similar to how Tesla was a few years ago. You can't win shorting this stock. Eventually, some guy on Twitter will post his YOLO calls that the lotto calls that printed like 10,000%. Right? That's how this always works. Meanwhile, most of FinTwit will get obliterated in the process and pretty much lose on every put that they buy. So, long story short, don't short bullish trends. They don't end well for those that are short most of the time. Now, you do get the occasional top tickers, but let's be honest. Who the hell is consistently top ticking stocks? Not us and definitely not you. So don't try this. It is not going to end well. Now, let's go into why bonds aren't moving. Again, for bonds to move, we need that recessionary pickup in the market, which we're not getting. Again, GDP coming above estimates, jobless claims coming in lower than estimates, and PCE coming down, all supportive of the soft landing. Soft landing is not a bullish bond scenario. The soft landing is not what the bond bulls want to see. They want to see the hard landing.
Yeah, now, they want to see the Fed panic, cut yes. rates, the whole nine. That's what they want to see.
Right. And that's something that you're just not going to see at the moment. Let's also, before you go and start bugging out, I know you're probably thinking, you're listening to this podcast like, oh, what's the point? Why not just long stocks? Why would I wait for the bond play? Answer is simple. The regimes are very intricate, the way that they play out. Just because we're in a risk on or risk off regime doesn't mean that everything is textbook. The markets are dynamic. You have to open your mind. You have to look at the situation and say, you know what? Equities are doing this, bonds are doing this. Equities seem like a good buy. They might be a good buy, but follow the math in terms of historical probabilities on where the highest confidence intervals are to compound your gains. Now, simplify that into basic terms. Follow the numbers and put your money where the highest odds of winning will be. Just because equities are up, they're up in a straight line. Number one, doesn't mean that they can't continue going up, but number two, doesn't mean that they're the best buy in the world. It just means if you're going to short something, obviously don't short a bullish trend in something that's going up. Equities can still go higher. But the confidence of how high they can go, it's unknown.
Right.
Due to the lack in the regime.
And something to say to that, this is what we do. So we need this confidence. We need these high probabilities because we use triple leverage in our plays. There isn't really any room for error when you use triple leverage. So we like to stick to these high conviction plays. And that's why this kind of happens. This kind of stuff happens all the time. Equities rallying and we're not long equities, or bonds rallying, we're not long bonds. We just follow our system. We're not going to catch every single move, but we don't have to because we use triple leverage. So whatever we do catch, any potential underperformance that our portfolio may have had gets made up rather quickly because we are using leverage.
Right.
And so that's the way you got to use leverage. You can't be taking every single play with leverage because you're going to get blown up.
Yeah, we'll talk about that too near the end of the podcast. But let's go over what's going to happen next week in the markets. Even though we have a shortened week, you want to take us through, Artie?
Yeah. So Tuesday's a holiday. Markets are closed. Monday, markets are closing early. We do have ISM on Monday. Wednesday, we have Fed minutes. Thursday, pretty big day. We've got JOLTS. We've got PMI, jobless claims. So Thursday is going to be a big day to look out for. And then Friday, we do have employment numbers coming out. So even though it is a holiday week, it is going to be a pretty hefty week. And there's going to be some pretty important information coming out that will definitely affect bonds for sure.
Right. And even the Fed expectations of where they're going to bring policy, I assume that I can almost guarantee that the employment situation is going to move that expectation one way or another, but we'll see when we get there next week. And let's go over what the market's expecting the Fed to do at the next July meeting. So right now we're expecting an 84.3% chance of a 25 basis point rate hike. I personally still think that this is an overstated percentage, meaning I think that the market's a little eager in terms of what the Fed has been saying to get this rate hike in. And I don't think what we've been seeing so far in terms of economic figures supports the need for another rate hike. And I do think that the Fed is currently restrictive enough. And I've gone over this on Twitter. And what I mean by that is, if you look at the numbers that are coming out today, you might say the Fed is not restrictive enough. I mean, core PCE is still in the mid fours, right? So there's only I think it's like an 80 basis point spread between the Fed funds rate and the core PCE on a year over year basis. You might be like, oh, that's not restrictive enough. We need to get higher. But the problem is when you have inflation moving as fast as it has moved from COVID going down, right? Deflation, and then reversing from extreme or not extreme, but from deflation to inflation in such a rapid time period, what ends up happening is these fundamental Fed tools that they use to watch the markets, like for example, the Fed considers the real Fed funds rate, meaning the Fed funds rate after inflation, to be comprised of the Fed funds rate minus core PCE. That's something that it's been standard at the Fed for a while, but we don't look at that. That's garbage, because what ends up happening when inflation moves so quickly, this lags drastically. And there's some tweets that I have on it. I posted a whole thread about this. What we like to look at are break-even rates versus the Fed. because what they do is they give you a perspective of where the market thinks, at least at this point in time, which changes every day, the inflation situation will be in the next 5 years, for example. Now, keep it simple. That's where the market thinks today. Don't worry about where inflation is 5 years from now. Just think about it as the way the market perceives inflation risk today. So that's much higher. We're talking almost 300 basis points of differential there, meaning the Fed is rather restrictive. And my whole thinking behind why we may not get this rate hike is because when the Fed is going to set themselves up for a pause, Powell has come out multiple times already and made it very clear with his subliminal messages towards financial conditions and expectations, where the Fed knows if they start announcing a cement pause, what's going to happen is the market's going to start flipping to rate cuts. And we're going to run into the situation where at every meeting, 1 to 2 meetings out, we're going to start seeing rate cuts. And every meeting that goes by, those rate cuts are going to get removed and they're going to get repriced. And you're going to get this situation where you're basically just pushing forward rate cuts. And the Fed doesn't want to loosen policy like that quickly, because what's going to happen is if the Fed starts expecting rate cuts, the 2-year bond is going to go down. A 2-year yield is going to go down, excuse me. Things are going to start to loosen in the economy. And
yeah. Well, I know for a fact if they did that, housing would explode. Everyone would be buying homes and just expecting to refinance down the line when they do cut.
Right. And that's why Powell's making statements saying, like, we won't cut rates for years. He's trying to basically solidify this idea, because again, to him, expectations are as good as actual policy. So I'm thinking this is the way I'm looking at it. The Fed's queuing up the market to give this idea that they are going to possibly hike twice again. And when they get to the meetings, they may just push those 2 hikes out. And eventually the market will call bullshit. But the idea is buy as much time as you can to keep the policy as restrictive as you can for as long as you can, because once inflation gets into the 3s and 4s area, or consistently in the 3 to 4% or 2 to 3% area, then it doesn't matter so much if they start expecting rate cuts and the Fed doesn't cut. Then you're really just restrictive with minimal inflation risk. Now let's talk about the inflation risk. So we've been very, very clear pretty much all year, the last 6 months, that inflation was fighting basically a downhill battle, right? Like, it was easy. Base effects, if we measure inflation here, let's take a look. So let's take a look here, right? So inflation ever since June 2022, as it comes lower, as it comes down, you're fighting these base effects from last year. Meaning, if inflation is not as strong as it was last year at this time, it's going to be lower. And that's a simplified version of base effects, but you get my point. This is why inflation has been able to fall so quickly, because the Fed's policy has worked. It has done something. It's slowed inflation down to a degree where base effects are in play. The problem is when we lapse this June period. And the easiest way to understand this is by looking at commodities, right? For example, let's take a look at commodities, right? June 2022. We're here. It's very easy. This is a strong decline, right? I mean, we'll just take a measurement from the June peak to where we are right now. We're talking 25%. That's a negative 25% factor in inflation, right? You could see how this is benefiting the lower inflation numbers. The problem is once you eclipse this peak, for example, what happens in July, right? Let's take a look at July, the end of July to where we are right now. That negative 25% only turns to 9%, right? So it's not out of this world to think that inflation can bounce. And we've been pretty straightforward about that inflation does not come down in a straight line. Very rarely does inflation go on a major run. Even here, right? Inflation in the 80s, we had this bounce. So it's not, I mean, we were talking about massive deflationary pressures in the 80s, but you get my point. It doesn't, a lot of people are looking for this. They're looking for the drop and then this run to new highs, which I don't think the Fed is going to let happen realistically. I mean, the Fed cut rates rather quickly here and they had to rehike. The Fed is not going to let that happen. So the Fed's going to hold rates, and as inflation falls, the Fed is going to become more and more restrictive naturally by just holding rates where they are. They don't need to run higher to 6, 7, 8% for no reason. They can just hold it at 5. As long as CPI stays under 5% year over year, they're restrictive enough. And we're at 4 right now. And we will, if we do bounce, we'd have to bounce over 5, which means we'd have to see some sort of inflation acceleration. It might not be a lot, but the first key to understanding the inflation acceleration from here is just look at commodities and bonds, right? Bonds would be starting to break lower significantly. Commodities would be breaking out. Commodities are in a bearish trend. They're not even near Momo yet. Yes, we could get that removal of base effects to where, by September we're going to be looking, or October, or even here by January we're going to have this issue where inflation could be, commodities could be an actual positive contributor to inflation, where they were, as they are right now, negative. But they would have to be a significant contributor to really ignite this inflationary move. And obviously, the remaining, now you might say, okay, well, there's these services that are much stickier, and yes, they are, but they will slowly break down. They will slowly come down. And the key here is, will they break down while commodities are down? So when commodities reverse, the contribution of the reversal isn't as significant as it would have been now or in the last 6 months. That's going to be the key that we're going to have to wait and watch and see. But I do think the Fed has themselves, they have the policy in a situation right now where they can hold. And why add fuel to the fire if you don't have to, in terms of getting inflation lower? Because obviously inflation is going down. So I don't know if it necessarily makes sense to add another 50 basis points to the funds rate, but we'll see. They could do it, and in my opinion, this would be a policy mistake. I think you'd want to see inflation firm up a little bit before you start doing this. I think that.
Well, do you think it would really cause much more damage though?
No, it's not about causing much more damage, right? It's about, they also want to put themselves in a position where they don't, their fear is also latency, right? So if they hold rates at 500 basis points and inflation does start to reaccelerate, but maybe it takes 3 or 4 months to reaccelerate, or 2 Fed meetings, the Fed's going to then have to, it's almost like you hike now and you kill future momentum, because once that inflation starts moving again, like is that extra 25 or 50 basis points going to stop that inflationary move? Because theoretically it's not, right? We know 25 basis points isn't going to do anything. 50 basis points maybe. It's really the Fed targets and tackles inflation in 100 basis point increments, right? That's why they were hiking 75 basis points all pretty much throughout 2022. So their idea is like, okay, if I see inflation right now and it's coming down, and I can get ahead by going 50 basis points, maybe if inflation starts reaccelerating, it won't have that momentum because the market's restrictive enough. In reality, they're already restrictive enough, but depending on how these members look at inflation, if they're really just focused on the real Fed funds rate, which is Fed funds minus core PCE, in their eyes, they're nowhere near restrictive enough. But I don't think they're that stupid. I mean, they could be, right? I guess we'll find out. But I do think that there's a good probability that this is overstated. I mean, if I had to throw a ballpark guess out there, I think we're closer to 50% than 84. To have such a finite number on this, like what happens if something blows up in the jobs report next week? Like there's too many factors. And then I think we might also get June CPI print, right? Before this meeting. We do get June CPI print before this meeting. There's a lot of things that can happen before this meeting. So like to put the odds of obviously I also don't think they're going to do 50 basis points either, right? So like there's a pretty decent risk reward scenario going on here where I don't think the Fed is going to stop and then jump to 50 basis points. So realistically, you're looking at a max probability of 25 basis points. So there's an 84% chance at 25 basis points, which means you have 16% downside if you're going to bet against this, where if you don't get it, you have 84% upside. So it's pretty interesting. I'd recommend some take a look at it, those that are active in the market, especially in the short-term interest rate market. But for the regular people, don't even worry about this. This is all noise. Don't focus on this. I want everyone to understand that it's very important you take a bigger picture view on the market and in the cycle as a whole, because the last thing you want to do, okay, is be that person that has no funds available when the real bull market comes. You don't want to be that guy that sits there and is like, I fucked up. And that is a lot of people in this market. There's a lot of people. Some of you guys are probably listening to this and you're more active in the markets. Now, you guys think that day trading is going to be profitable, and you can debate me. I'm open to those debates on why you think you're going to make money day trading. Some of you won't like to hear this, but it's the truth. In reality, day trading is one of the biggest financial crimes that has ever been committed in recent times here in terms of the mass population, right? In terms of the regular normie investor, the simp. It is the biggest financial scam that's been pulled off because you have commercialized a system for a low probability of success for you and a guaranteed probabilities of success for the broker dealer. That's what's happened here, right? You go into every day, if you're a day trader, you don't know if you're going to make money or not, obviously, right? Nobody knows. But the broker knows. Either they're getting payment for order flow or payment for your options contracts. They're getting paid. Okay? You are not, but they are. So it incentivizes them to figure out how to give you the sexiest platforms, the best features, all this bullshit, like a casino. That's what it is, right? You want to go to the casino with all the nice lights, the nice drinks, the nice tables. You don't want to go to a casino in the middle of the woods, right? So you want all this nice experience.
So something funny too, kind of with that casino vibe is you go into a casino, they don't have clocks, they don't have windows, you can't see what time it is. Take a look at your trading platform, look at the options chain, look at your positions. Do you see a dollar sign anywhere?
Right.
There's no dollar sign. There's only numbers. They don't put dollar signs there because then they don't want you to associate these numbers with dollars. They want you to just, contract is 1.5. All right, I'll buy that contract. It's nothing. That's $150. They don't want you to make that association. It's the same thing. The same tactics that casinos use.
Yeah, and you guys probably aren't going to care about what I'm telling you, but zero DTE options, if you think they were truly made for hedging, you've been finessed. Zero DTE options are the CBOE's biggest money grab of the last 10 years. Like, think about it. They have options that expire every single day, meaning they are generating an entire volume train just for individuals who want to gamble. That's what that is. Like, realistically, there's no. I'm going to put it to you this way. The most profitable option you can ever buy is not some bullshit that expires in 24 hours. The most profitable option you could possibly buy that has the odds in your favor is a leap, because you negate that time factor that eats away at your investment, right? So if it's not a leap, if it's something that expires in 24 hours, you have to get the timing down perfectly, the move down perfectly. Not only the move, you have to get the size of the move down correctly. I mean, the timing, the direction, and the move, basically, right? You have to get all of these things down to perfectly for you to make money. And the odds of you doing that are very low. You might say, you know what? I'm going to just study. I'm going to figure it out. I'm going to sit down. I'll figure out a way to do it. And I encourage you to do that. I encourage you to sit down, look at your computer, take out an options chain, and evaluate how many times options expire worthless. I want you to look at them, and I want you to say, how am I, some normie on a fucking laptop, right, in the middle of nowhere, going to beat the market maker? I encourage you to do that and figure that out. Because if you do figure that out, you will never need to listen to me again. You'll be rich. You'll be richer than you could possibly imagine. But the problem is you won't figure that out because it doesn't exist. These people on the internet that are boasting about how well they're trading these zero DTE options and all this other shit, don't think for a second they're not getting paid promos. They're not trading with simulated money. They're not, getting rebates from the broker dealer for promoting them. Like, all this shit exists behind the closed doors. Like, this is not like something that you're oh my God, this guy's a gee, he's trading these lotto options, he's making a shit ton of money. Okay, show me somebody that trades zero DTE options for more than the last 2 years that has made significant amounts of money. You probably can't find one. You might think you know one, but let's be honest. Have you been able to do it yet? And that's the key, right? Like if you've been trying to do it and you can't do it yet, don't think it's because I'm not studying hard enough. That's some sales bullshit. That there's no amount of studying you could do. Day trading is again a financial crime. If unfortunately it won't ever get pursued, but it's a financial crime against poor people. No rich person needs to day trade, right? Think about it. If I gave you $50 million right now, would you fucking go out there and buy a zero DTE option on Apple? Think of it, you
Yeah.
wouldn't, right?
Yeah, it's funny. Like
So
how many billionaires do you know are day traders, or they became billionaires from day trading?
I can't tell you one, but you know what
There's
I
not
can
a
tell you.
single one.
There's billionaire market makers though.
Yeah.
Yeah, that's the thing. It's a casino. So you have like the biggest advice or the best advice, I shouldn't say biggest advice I can give to any of you guys that have just stumbled across this page or don't know market radar well is I want you to sit down at your computer and I want you to analyze the probability of you making money. You should be focusing on the thing that will make you money most consistently. There's no, oh, I blew up my account. Fuck that noise. Okay? Focus on what will consistently make you money, not something that you're going to run around and I have to study more of study volume, study this. Trust me, if it was as simple as studying volume profiles, moving averages, something this rudimentary, the market makers would have already exploited it. You don't think Citadel or any of these banks are sitting there with PhD quants that are running models ahead of you already? You think you figured something out? And this is why DDAP is very different because DDAP is over the long term. It's very easy to win in the long game when you sit back and you watch, right? It's very like if you were to look at a profitability curve of time spent in, or I should say, time hold the duration of your holding and the probability that you make money, it would be an exponential curve, meaning the longer you hold a position, the higher the probability of you making money goes. The problem is that's real. With options, it's inverse, right? The longer you hold an option, it eats away at your profitability. Why? Because the market maker has to win. They know that the longer you hold that option, the more chances they have to lose money. So they have to take your option premium away, which is the theta decay. It's real simple. It's a rigged game from the beginning, from the market maker or our premium seller. It's in their best interest for your option to decay in value, which is why it does. No option writer would write a contract that doesn't have time decay because the time factor is the edge. That's why you have time decay. And I want you guys to pay attention. Don't do something stupid. Don't go out there and YOLO this, YOLO that. And what ends up happening at the end, like I said earlier, you want to be ready. When the market makes a move, you want to be there. You want to have a clear mind, clear conscience. You don't want to say, oh man, I just blew up my account. I got to go away from the market, all this other bullshit and horseshit, right? Nonsense. The people if you're following someone that is trying to sell you that you will day trade, you are being finessed. I promise you. Day trading crypto, day trading anything. And I'll say this to you as well. Someone please come out and correct me if I'm wrong. If you're a successful day trader, you're not listening to this podcast. You want to know why? Because you're already making money from your subscribers. And that's really what this is. They make money from selling a product, not trading. So it's all a scam, unfortunately. It's sad. And I hate seeing normies getting taken advantage of like this because in reality, they don't end up making any money. I would be surprised if there is a day trading service out there that you pay X dollars for in a year and you can easily make 10 times that service cost in a year trading options consistently. I don't think it's possible. I've never seen it, never heard of it, been around for a while. Someone can come and correct me if I'm wrong. But I think that's where we'll wrap it up this week, guys. I thank you guys so much for listening. If you have any questions, reach out to us on Twitter, in our Discord. We're happy to talk. Have a great holiday weekend.